So as I said in my last video, the period of zero cost money and central bank buying support for the market is drawing to a close. This is a paradigm shift. And with that, we believe the sectors and the stocks that will perform better will shift. Here are 5 ideas. Number 1, choose value stocks over growth stocks. The MSCI World Value Index has started to outperform the MSCI Growth Index very recently. And I think that's going to continue. So value stocks are sectors such as financials, healthcare, and consumer staples, among others. Banks in particular are defensive in this environment because rising rates can help raise their net interest margins. Growth stocks, as defined by the MSCI World Growth Index, is dominated by tech. Now, rising interest rates pose a particularly difficult challenge for tech stocks because a larger part of their valuations is in more distant earnings. So they will suffer more duration risk than stocks in more traditional sectors. Idea number 2, energy stocks. I had been recommending the oil majors since middle of last year, when West Texas Intermediate crude was trading in the range of US $30 to $40 a barrel. It is now trading over 83 US dollars a barrel. Now, energy stocks, to be clear, have rallied big time. The S&P 500 Energy Sector Index is up 152% from its March 2020 low. So we are probably in the second half of the game, as it were, maybe even the final quarter. But with supplies of coal and natural gas unable to cope with demand and OPEC Plus holding back crude oil supply, we could see yet higher prices as we approach the northern winter. Idea number 3, Japanese stocks. The strengthening of the US dollar in response to higher US Treasury yields has driven dollar yen from 109 to 114 in less than a month. A weak yen is a boon for Japanese exporters. Now, I reckon this could continue to support Japanese equities in coming months. Idea number 4, Chinese equities. They are out of favor and beaten down. But the CSI 300 has seen some tentative support at the bottom of an uptrend channel from the year 2009. The negativity around China is overdone. The economy will stay resilient despite Evergrande's financial troubles. Manufacturing will likely continue mostly undisturbed through the winter, despite reported energy shortages. I see value in Chinese equities for long-term investors. Number 5, the US dollar. Higher US Treasury yields, particularly at the short end, are generally supportive of a stronger US dollar. Now, mind you, the dollar has gone up a lot in recent months and could soon stage a correction. But I see a resurgence of a strong dollar next year as we approach interest rate rises in the US.